TRUFIN. They came out with an early trading update. Now, pay attention to that, okay? There's an old saying in the markets that companies rush out good news, they tend to delay bad news. So if you're waiting for news, it should come out. It hasn't come out. What's going on here? And if they're waiting for a contract, whether that, but if it's good, you just get it out, So TRUFIN came out with this trading statement, and they did say 12 months performance, the trading update for the full year, expected significantly ahead of market expectations. The group is now expected to be EBITDA positive full year. This outperformance has been driven by PlayStack's launch of Balatro, their fastest selling PC ever, and newly launched Abiotic Factor, which surpassed 250,000 units sold in the first 8 days of sales. And this is going to be quite a busy year for PlayStack. They've got, I think, 2 more platform games, which are the big games they've done deals with the platforms. But these are independents. And they've got Mortal Shell coming up. Mortal Shell 2, which sold 1 million units. And then we're not even talking about Oxygen or Satago. Satago is an amazing, company. And Oxygen just keeps plowing away with forward visibility, like 3 to 5 years in revenue. I think 98% of their revenues are contracting for like 3 to 5 years. Phenomenal visibility. They were offered 26 million for it over a year ago. I think now the fundamentals of this business is twice as good as it was back then. So if you think it's twice as good and you say you get 50 million valuation for it, Starga's supposed to be worth about 100 million. Done deals with Lloyds, Sage. There was another bank. There was a Bank of Ireland recently. Who was it? Best in class software. Easily, Lloyds, stop using their own software. So rip it out. Let's get Stargo in. Because of that. Bank of Ireland, that's Stargo. Bank of Ireland, Lloyds, Sage, FTSE 100 companies. The FTSE 100 can only use the best software. That's what they're using, okay? So I really like Stargo. I think we're only at the start of TRUFIN. It's not going to be compelling yet, but I expect this to be a chart, a MicroCap League riser, okay, going forward. So we got 84 million market cap, 81. So we got cash there. Top line growth is good. Of course, it's not quite profitable yet. Top line growth again was good. So it's worth looking. The health is fine. Top, gross margin 70-odd%. We are in an uptrend. Broker target still after this rally, and we have rallied quite nicely. Still is 61% up. So I think it's 130 this thing. I think, is it? Yeah. I think was that the target? I think 130. Yeah. So that's what I'm saying. That's only 12-month target. Okay. So if we look forward, they expect to do 109% top line to 38 million this year, then 15 and 20. And you can see the margins get better as we go along, pretty much 60, 70, 10, 14 on the EBITDA. They reckon this eventually it's going to be up 20, 25 minutes. It's still early stages. I mean, 20, even 26 stages. Value starts to get better. I've been very conservative. I've got 50% target, even from where we are. But I just think, these businesses are only going to get better. Starga's going to get better. Auctions going to get better. They may just sell PlayStack. They may sell one or two of them, sell all in the end. But I just think it's going to get better. And I don't want to prejudge what you're going to say, ladies and gentlemen. But what do you say? One for the watch list or not? Graham, TRUFIN, yes, TRUFIN looking good. Rob, TRUFIN's new game paid for itself within a week. That the development cost of the game, that sounds pretty compelling. Yes, that's right. Darren Harris, I sold out at a loss on TRUFIN a few months ago. Hey ho, listen, I know what you mean. But sometimes it's just timing, and sometimes you just get back in. And if you talk about, and I think that's a 12-month target, by the way. That so if you talk many years down the line, it doesn't matter if you made a loss, so you can get back in. If you know about a company, sometimes if it's painful, just cut the loss. Like I said, 20% always pretty much now. Every time I go to a company, 20%. If it drops that and cut, start small, cut. The loss is small, the pain is small, and then you can revisit, and thing. But don't go chasing losses down. It gets more painful. It leverages your portfolio towards your losers rather than your winners. By the way, in the book, I talk about scaling up. A good scaling up model is another idea, by the way, is if you have, like, let's say you put 2% of your initial total portfolio value into a stock, which is not a lot, is it? So let's say you got 100 grand. I always use that, regardless of whether you have that or not, or less or more. 100 grand, 2% is 2 grand. Okay, so initial investment, 2 grand, and you put 20% stop loss on that. Okay, so 20% of 2%, not a lot if you lose, is it? Right? When it rises by 30%, add another percentage point, another total, or £1,000, that's half what you initially put in, basically. That's 3 grand, right? And you can actually put now a 20% stop loss below it all, because you are 20% up. Even though one's 30, one you just bought it at, that's 20% up. So you've still got 20% room of error, risk-free trade. So that's worth thinking about. So if you're wondering, when do I scale in? To be safe, if you put 5% start or 4% initial, go half that at 30%, and you get the stop loss can be 20% below that, and that's still break even. So you've got more money in, no more risk, more reward though, because you've got more money in. See? There we go. Anyway, yes, Brian, yes. Simon, does that make sense to you? Yes, looking good. True, yes. Ed, Tom K, yes. 3 rockets.